Welcome back to the Deep Dive. Our mission today is, well, pretty focused. We've got a stack of sources on Henry Schein Inc., that's ticker HSIC, and we're digging in to figure out if this 93-year-old healthcare distribution giant is really set up for the future.
And just to ground us, the specifics, analysis date is October 5, 2025, and the share price is sitting at $67.03. We're looking at a company that's, absolutely vital to dentists and doctors' offices, but it's facing some pretty significant transitional challenges right now.
Yeah, those challenges are exactly why we're diving in. This world of digital everything, constant inflation worries, potential political risks.
Right.
Quite a company built on distribution really pivots successfully, especially towards, higher growth and better margins.
Yeah.
Because the valuation gap here is kind of startling. Our own internal analysis, and when we tried to be conservative, it points to an intrinsic value somewhere between $82 and $104 per share. That's way above the current price.
That big a discount really shouts skepticism, doesn't it? If our numbers suggest, 22% to maybe 55% upside, the market is clearly saying, we don't fully trust they can pull this off.
Exactly. So we need to unpack the bull case, the bear case, figure out what risks are baked into that $67 price.
Agreed.
Okay, before we get into the nitty-gritty, just a quick reminder for all of you listening. If you find these deep dives useful, please do like and subscribe to the Stock Analytics AI YouTube channel. We're working our way through the S&P 500, and members get to suggest tickers for priority analysis. All right, let's start at the beginning. The foundation of the business.
The bedrock of the business, understanding Henry Schein.
Well, Henry Schein is all about scale. It's the world's biggest provider of solutions for office-based dental and medical practices. They serve over 1 million professionals globally.
Wow, 1 million.
Yeah, it's huge. Just to give you a sense of size, total sales in 2024 clocked in at $12.7 billion. Market share-wise, they dominate something like 35% in dental products, maybe 25% in medical products go into those office practices.
That scale is definitely the foundation. But, for a company that's almost a century old, the big signal now is change. They actually revised how they report their financials back in Q4 2024. It's part of this strategic plan they call Bold D+1. Feels like they're trying to tell the market, hey, we're not just a massive box mover anymore.
Exactly right. This whole reporting change is designed to spotlight where they see future profitable growth.
Yeah.
They've split things into 3 new segments. First, you've got the traditional core, the big lower margin part, global distribution and value-added services. That pulled in $10.8 billion in 2024 sales.
Okay, the legacy business. And then the focus areas.
Right. Second is global specialty products. This is their high-margin target area, doing about $1.4 billion. Think, premium stuff like dental implants, biomaterials, those complex endodontic supplies.
The higher value items.
Precisely. And third is global technology. This includes their practice management software. Dentrix Ascend is a big one, plus digital imaging, other tech solutions. That segment brought in around $7.6 billion last year. The whole strategy is to shift the profit mix pretty aggressively towards these last two, the stickier, higher margin stuff.
And that massive scale we talked about, that must give them a serious competitive edge, right? Huge purchasing power, efficiency. I think I saw a 99% order fulfillment rate historically.
Yeah, that's right. Operational excellence is key. And the tech side, like Dentrix, that creates real switching costs. Once a dental office is running on your software, it's a major pain for them to switch. That helps lock in future revenue.
Makes sense.
And fundamentally, they're playing in markets that are growing and pretty resilient. The dental market, for instance, is projected to grow somewhere between 6.3% and maybe even 9.2% CAGR. That's driven by, the aging population, plus more demand for cosmetic procedures. Competition's tough, though. You've got giants like McKesson on the medical side and specialists like Patterson really focused on dental.
Okay, that sets the stage. Which leads us to something absolutely critical right now. Who's steering the ship?
Evaluating the captains of the ship. Management and capital allocation.
Yeah, the biggest story here is the CEO transition. Stanley Bergman, who's been CEO since 1989, that's 36 years.
36 years.
He's retiring at the end of 2025.
Wow. That's practically an entire career leading one company. How do you even quantify the risk when someone with that much history steps down? Is there like a Bergman premium baked into the stock price that might just evaporate?
That's exactly the concern. It creates this unquantifiable risk. The market has likely priced in some value for his leadership, his stability, and that's now uncertain. We should acknowledge, though, they've handled crises pretty well recently. Remember that cyber attack in October 2023?
Vaguely.
Cost them about $9 million to fix, but they managed to claim $40 million back from their insurance policy. They had
Wow.
$60 million in coverage, so, that shows some operational competence under pressure.
Okay, good point. Let's talk capital allocation then, because actions speak louder than words, right? Management's policy seems clear. No dividends for, what, over 15 years?
That's right, no dividends. Instead, they pour cash back into the business and, crucially, into share buybacks. It's a strong signal they think their own stock is undervalued.
And are they backing that up with real money?
Oh, definitely. Very aggressive buybacks. They bought back $259 million worth of shares just in Q2 of 2025. And then, just last month, September 2025, the board okayed a new $750 million share repurchase plan.
$750 million.
Yeah, that represents about 9.0% of all their outstanding shares. That's a huge vote of confidence, very tangible.
Okay, wait. If management is so confident they're throwing $750 million at buybacks, what's the big red flag? There has to be a but here, right? What number shows why they need this bold D+1 strategy so badly?
Yes, that's the core tension. The critical issue, the number that really stands out, is the declining return on invested capital, ROIC.
Right, how efficiently they use their money.
Exactly. And right now, the trailing 12 months, or TTM, ROIC is just 7.4%. That's way down from a peak of 12.0% back in 2021. This erosion in efficiency is the fundamental reason management is pushing the bold D+1 pivot so hard. Their traditional distribution model just isn't generating the returns it used to.
So that falling ROIC is the why behind the strategy shift. Let's dig into the financials a bit more to see how bad is it?
Financial analysis.
Okay, the numbers definitely confirm that ROIC pressure. Revenue growth, it's okay, but modest for a giant like this, about a 4.88% 5-year compound annual growth rate. Nothing spectacular. But the real story, the pain point, is in the margins.
Let me guess, they're shrinking.
Significantly.
Yeah.
The TTM operating margin is only 6.06%. That's down from a high of 7.54%. And the net margin, what's left after everything, is squeezed down to just 3.05%.
3%. So for every dollar of stuff they sell, they keep only 3 cents. That really drives home the bear case, doesn't it? Even with that massive scale, they can't escape the squeeze from competition and costs.
It definitely provides the quantitative evidence for that argument. However, there is a counterpoint, and it's in cash flow. Free cash flow actually bounced back really strongly in 2024, hit $700 million. That was almost double, a 98.3% jump from 2023.
Okay, so cash generation is still decent.
Yeah, and earnings are generally consistent. They've never actually posted an annual loss, which is impressive, but they can be lumpy. Q2 of 2025, for example, their earnings per share came in at $1.10, but the market expected $1.19. That miss triggered a pretty sharp drop in the stock price.
Right, the market hates negative surprises. What about the balance sheet health? Are they taking on too much debt for these buybacks?
Well, the balance sheet looks manageable. Debt to equity is up. It's at 0.51 now, and yes, that's largely because of the buybacks. But their liquidity seems healthy. The current ratio is 1.41.
And a current ratio above 1 is generally good, right?
Right.
Means they can cover short-term debts.
Exactly. 1.41 suggests they have pretty solid cushion for short-term obligations.
Okay, so it's a mixed bag. Stability, good cash flow, but really concerning margin pressure. How does the market actually value all this? What's the PE ratio telling us?
Relatively speaking, the valuation isn't too crazy. The TTM price to earnings, or PE, is around 21.6x. That's actually fair, maybe even a little attractive compared to its own 10-year historical average, which is about 22.1x. And it looks definitely cheaper than a peer like McKesson, which trades at over 30x earnings.
Interesting. Okay, so we've got the business, the leadership challenge, the financial picture. Now let's turn outward. What are the external market forces saying?
Market sentiment.
Well, if you look at Wall Street analysts, the consensus reflects that mixed bag we just talked about. It's basically a hold.
Not exactly a ringing endorsement.
No, the average 12-month price target is somewhere between $73 and $77. That suggests they see maybe a little bit of upside from the current $67, but there's clearly no strong conviction that management will nail this bold D+1 execution.
And recent news hasn't helped, right? You mentioned the Q2 earnings miss.
Right, that EPS miss knocked the stock down over 9% almost immediately. That hurts sentiment. And the other big cloud hanging over them is this ongoing investigation by the U.S. Commerce Department.
The tariff issue.
Exactly. Potential tariffs on imported medical equipment. That kind of regulatory uncertainty really puts a damper on investor enthusiasm. Nobody likes unpredictable government action.
And are people betting against the stock? What do the technicals look like?
Yeah, the technical indicators definitely lean bearish. Short interest, that's the percentage of shares borrowed and sold short by people betting the price will fall. It's quite high, somewhere between 7.81% and maybe even 9.06% of the available shares, the float. That's significant skepticism.
Wow, nearly 1 in 10 shares bet against it.
And reinforcing that, the stock price itself, $67.03, is trading below both its 50-day moving average, which is around $67.93, and its longer-term 200-day moving average near $69. That pattern signals a pretty persistent technical downtrend.
Okay, so a clear downtrend. Given that, who is actually buying and holding this stock? Let's look at ownership.
Ownership's
Well, institutional ownership is incredibly high. It's actually over 100% of the outstanding shares, which sounds weird, but it just reflects how widely held it is by major funds, ETFs, etc. It's a core holding for many.
But isn't there one particularly interesting, very active owner that recently showed up?
Ah, yes. The most significant development here, absolutely, is Colbert Kravis Roberts & Co.,
KKR.
the private equity giant.
Exactly. They are now the top institutional holder. They've got 15.6 million shares after making a $250 million strategic investment back in May 2025. And crucially, KKR is not known for being a passive, quiet investor.
Right. They usually want changes, and they want them fast.
That's the potential catalyst here. KKR's involvement strongly suggests they're going to be pushing management, maybe quite hard, to accelerate that BOLD+1 strategy to unlock the value they clearly see. They look at that gap between $67 and our $82 to $104 intrinsic value estimate, and you can bet they want to close that gap sooner rather than later.
So KKR is a potential accelerant. What about the insiders, the actual management and board? Are they buying or selling? Insider ownership overall is pretty low, actually, around 1.1% to maybe 1.35%. But if you look at transactions over the past year, the net activity is positive. Insiders bought almost 120,000 more shares than they sold.
Any notable buys?
Yes, one stands out. Director William K. Daniel bought 10,000 shares back in August 2025 at prices pretty close to where the stock is now. That's usually seen as a classic bullish signal, an insider putting their own money on the line.
Okay, so KKR pushing from the outside, at least one director buying on the inside. Let's try to synthesize the big risks now.
Risk assessment.
When you boil it down, the main story threat-wise is that combination of intense competition and stubborn inflation. Those two forces are directly hitting the operating margins we talked about. It feels like a structural headwind for their core distribution business.
And then there's that immediate geopolitical threat. We mentioned the potential U.S. tariffs. You said that's already impacting things.
It is. Management specifically pointed to the threat of tariffs as a key reason why U.S. dental equipment orders slowed down in Q2 of 2025. So the uncertainty itself is already causing customers to hesitate on big purchases.
That's a problem.
And the companies basically admitted that if these tariffs actually happen, price increases will be, quote, unavoidable, given their global supply chain.
So pass the cost on and risk losing customers, or absorb it and kill margins even further. Tough spot.
Very tough. And don't forget the broader macro picture. Higher interest rates make everything more expensive. It makes Henry Schein's own M&A strategy costlier, but maybe more importantly, it makes financing more expensive for their customers.
Right, the dentists and doctors buying the equipment.
Exactly. When borrowing costs go up, practitioners are less likely to splurge on big capital investments, like fancy new X-ray machines, which are high-ticket items for Henry Schein. They just delay those purchases.
Okay, a lot of headwinds. Let's try to wrap this up by summarizing the opposing viewpoints. All right, the bull case. The bulls see Henry Schein as this dominant market leader, protected by its massive scale, the trust it's built over decades, and those switching costs, especially on the tech side. They see a company proactively pivoting with the BOLD+1 plan toward higher margin businesses.
Plus the buybacks.
Right, management signaling undervaluation with aggressive buybacks, and maybe most importantly for the bulls, KKR is now involved. That provides a potentially powerful activist catalyst to force value creation and make sure the BOLD+1 plan actually gets executed effectively.
Okay, that's the optimistic view. Now, the bear case.
The bears look at the hard numbers. That persistent margin pressure, the declining ROIC, they see that as concrete proof that the core business is struggling to adapt. They see the high short interest as confirmation that many smart investors are betting against them.
And the risks.
Compounded by the geopolitical risks, like those tariffs, and critically, the huge internal uncertainty around the CEO transition. Who takes over? Can they execute this tricky BOLD+1 plan? The bears argue it's risky, complex, and absolutely not guaranteed to work well enough to offset the pressures on the legacy business.
So we come back to that valuation gap. The market prices it at $67, reflecting all those bear arguments.
Yeah.
Our model, though, using what seem like reasonable assumptions, gets to $82 on the low end, maybe even 104 raws. How does the model justify that optimism?
Well, our educational DCF model hinges on essentially two core assumptions, which we think are conservative but achievable. First, that the core distribution business, despite the pressures, manages to maintain its modest, say, 3% revenue growth, proving its resilience.
Okay.
And second, that the Boldy +1 strategic pivot is executed well enough to gradually, slowly improve the overall operating margin from that low 6.06% back towards maybe 7.5% over the next 3 to 5 years. Not back to the peak, but a noticeable improvement.
And if they hit those two things, modest growth, gradual margin recovery.
If they achieve that, the math in the discounted cash flow model spits out that intrinsic value range of $82 to $104 per share.
So the final takeaway for you, the listener, really seems to be this. Yes, the stock at $67 looks cheap compared to that potential value, but that discount exists for very real reasons. The margin pressure, the execution risk of the pivot, and especially the uncertainty around the new CEO. You're essentially getting paid to take on that execution and transition risk. And building on that KKR angle and the CEO change, here's maybe a final thought to chew on. KKR, as we said, is known for wanting results fast. Will that urgency clash with whoever the new CEO is in their vision? Or could KKR actually provide the backbone, the support needed for the Boldy +1 strategy to succeed in a way it might not have otherwise? That dynamic KKR and the new CEO feels like it could define the story for the next couple of years.
Absolutely. And if you want us to dive deep like this into other stocks, particularly any in the S&P 500, remember we're covering all of them over the next few months.
Yeah.
Members who join for €4.99 a month get priority access and can suggest tickers for us to analyze.
That's right. And finally, the important reminder. This analysis was generated by an AI system purely for educational purposes. It is definitely not financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.